Hello, welcome back to Learn Economia. In this video, we are going to discuss the difference between fiscal policy and monetary policy with respect to pros and cons. We know what monetary policy is and what fiscal policy is, and I have done several videos on these, the instruments which are used in fiscal as well as monetary policy. So, when it comes to macroeconomic policy, it includes two sets of policies: the fiscal policy and monetary policy. Monetary policy is includes the management of money supply and interest rate by central banks. And when it comes to fiscal policy, it is a policy taken by the central government of a country through taxation and public expenditure. So, to stimulate the flattering economy, the central bank would be cutting their interest rate. I mean, the interest rate in the economy. So, as a result, it would be less expensive to borrow while increasing the money supply. If the economy is growing very rapidly, then the central bank would implement a tight monetary policy by increasing the interest rate in the economy. Now, coming to fiscal policy, what the government does is that a government will cut tax rate while increasing its own spending. So, this is to stimulate the economy. Whereas, if the government sees that if the economy is going through a inflationary phase, then the government would increase the tax rate and it reduces the public expenditure. So, we are going into the details of both fiscal policies and monetary policy with respect to the pros and cons. That means that the advantages and disadvantages. Coming to the overview of monetary policy, as I have already told, so this is a policy set taken by the central bank of a country. In the case of US, it is a Federal Reserve which takes monetary policies, and in the case of India, it is the central bank of the country, that is the Reserve Bank of India, which takes the policies. So, every country has got its own central bank which would be taking different monetary policies for the country. So when a country's economy is growing at a fast pace, that inflation increases to worrisome levels, what the central bank does is that it would increase the interest rate, and this is what is happening in India presently. The central bank has increased interest rate because the central bank would feel that there is inflation in the economy. Now, selling government bonds from its balance sheet to the public in open market reduces the money in circulation, because the government would be buying the bonds from the central bank. So as a result, money in the hands of government would be lessened. So the government cannot spend as it wished. In that sense, what happens is the central bank would be reducing the money supply in the economy. Now, if the traditional measures fall short, then what the central bank does is that it can undertake unconventional monetary policies such as the quantitative easing. We have already seen that the central bank uses both quantitative and qualitative credit control measures to deal with what to say price levels in the economy. Whatever be the policy taken by the central bank, it always aims at price stability. Now, coming to the pros and cons of the policies taken by the central bank, the pros include interest rate targeting controls inflation, implemented fairly easily. Central bank are independent and politically neutral. Weakening the currency can boost exports, all these kinds of things. That means that when the interest rate targeting controls inflation, then what it helps is that even though even though the central bank aims at controlling the interest rate, it actually leads to controlling of inflation in the economy. Now, this could be implemented fairly easily in the sense that uh, on every quarter. In every quarter, what the central bank does is that there would be a committee meeting, the monetary policy committee meeting, and which would be reviewing the present scenario of the economy, and on the basis of that, what the central bank does is that the central bank would revise its policy rates, its interest rates accordingly. Now, since the central bank is not influenced by any political agenda or political pressure, the central bank could take its actions without answering, without the need to answer to any political parties or any political any political pressures. So this will be helping the central bank to function independently without the pressure from the political side. Then weakening of the currency will definitely help to boost exports, because when there is devaluation, that means a reduction in the value of the domestic currency. This will help to boost the exports, and at the same time this will be leading to reduction in imports, because if you have a inflationary tendency in the economy, or if you have a deflation kind of thing, devaluation kind of thing in the economy, if it is inflation or if it is devaluation, what happens is that you have to pay more and more to your import. So in this case, in this scenario, what the government does is the government would cut short its imports. In that sense, we can see that weakening of the currency can boost exports and also reduce its imports. Coming to the cons, it have a time lag. The government will soon act, but the central bank policy would have a time lag. It cannot take a quick stand. The effects on the economy would take several months to materialize. So in that sense, we can see that this is considered to be a disadvantage with respect to the policy measures taken by the central bank or the monetary policy. Now, coming to technical limitations, we have to see that uh, this could be experienced with respect to recession or depression kind of thing, and also in the in the periods of uh, liquidity trap or recession. It has been experienced by many central banks that it couldn't meet its expectations. It couldn't meet the expectation of the public. So as a result, it was problematic with respect to the central bank decisions to keep their words. Now, we can see that the monetary policy tools are general and affect the entire economy. Even though the monetary policy tool, if it is something which is aimed at a particular sector, that would definitely have its repercussions on the entire economy. And the risk of hyperinflation is another problem. When the interest rates are very low, there would be over borrowing, which would lead to hyperinflation in the economy, because people will be having more money in their hands, which leads to hyperinflation. There won't be no enough goods and services. There won't be enough goods and services to meet the pent up demand, to meet the increased demand in the economy. As I said, there would be hyperinflation if the government if the central bank reduces its interest rates and people have more money in their hands than what is expected. Okay, coming to what fiscal policy is, having discussed the monetary policy, let's understand the meaning and the role of fiscal policy. As I have already told, this is designed and implemented by the government of a country, by the central government of a country. So this includes both taxation and public expenditure. This is something which has been supported by Keynesian economics. So Keynes says that whenever the private investment falls, it should be the government that should come forward and make investment. So in order to make aggregate demand increase in the economy, in order to increase aggregate demand in the economy, the government should come forward and invest. So there should be some kind of autonomous investment in the economy. Then by autonomous investment, the government could make uh, the money multiply in the economy as a result of multiplier effect. All these kinds of things were the theories. So let's understand the practical aspect, that is fiscal policy. What are the pros and cons of fiscal policy? We can see that there can be direct spending to a specific purpose, as unlike in the case of monetary policy, which cannot be peculiar or particular to a particular project or a particular sector. This fiscal policy can be aimed at the improvement of a particular sector, or it can reduce more the flow of money to a particular sector, or it can increase the flow of money to a particular sector. It can tax a particular sector, or it can give subsidies to a particular sector. All these could be made possible as a result of fiscal policy. Then it can use taxation to discourage negative externalities. What we know externalities are, I have already done videos on externalities. So if you are polluting, which the cost of which cannot be actually calculated, what the government can do is that the government could impose a tax upon the party which is causing this negative externalities. Now here the time lag. is very short compared to what we could see in the case of monetary policy. In the case of monetary policy, we could see that there is a time lag of months, but in the case of fiscal policy, there will be a quicker effect. Now, coming to the cons, we could see that it could be politically motivated. When the monetary policies are something which could be taken independently by the monetary authority of the country. Here, the fiscal policies are something which happens as a result of political pressure, and also tax incentives might be spent on imports. So, if you have a tax incentive, if a particular firm or a particular person is getting tax incentive, then it is very likely that the person would be spending, or the firm would be spending it on imported commodity. So if it is very likely for you to spend upon imported commodity, if you or the person or the firm, if they are spending on the imported commodity, that means the flow of money from our country to the foreign economy, so which is not a good thing. Then it can create a budget deficit. The same thing, the after effect of the same thing, if you are importing more, what happens is that this will lead your trade deficit to increase. Then, what are the main tools of monetary policy and what are the main tools of fiscal policy? Very important question. Main tools of monetary policy, these are quantitative and qualitative tools. Should contain what to say, repo rate, reverse repo rate, open market operation, then moral suasion, all these kinds of things. Then, what are the examples of fiscal policy? As I have already told, it would include taxation, public expenditure, etc. So that's all for today. Please like, share and subscribe to this channel for more videos, and I'll be providing the links of both my Telegram channel and Telegram group in the description box. So please like, share and subscribe to this channel. I'll be providing the links of both my Telegram group and Telegram channel in the description box. Please be a part of that, please.